Investing can be a great way to build wealth over the long term, but it can also be complex and intimidating for beginners. Diversify your investments. The wealthiest investors don't put all of their eggs in one basket. Instead, they spread their money across a range of different investment options, including stocks, bonds, real estate, and alternative assets like private equity or hedge funds. This helps to minimize risk and maximize returns over the long term. Diversifying your investments is a key strategy for minimizing risk and maximizing returns. The idea behind diversification is to spread your money across a range of different asset classes, industries, and geographic regions to reduce the impact of any single investment on your overall portfolio. One way to achieve diversification is to invest in a mix of stocks, bonds, and cash equivalents. Stocks offer the potential for long-term growth, while bonds provide income and stability. Cash equivalents, such as money market funds or certificates of deposit, offer safety and liquidity. Another way to diversify is to invest in different industries or sectors, such as technology, healthcare, energy, or consumer goods. This helps to spread your money across a range of businesses that are likely to perform differently in various economic and market conditions. Finally, you can diversify geographically by investing in both domestic and international markets. This helps to spread your money across different countries and economies, reducing the impact of any single country's economic or political events on your portfolio. By diversifying your investments, you can reduce your overall risk while potentially increasing your returns over the long term. It's important to note that diversification does not guarantee a profit or protect against losses, but it can help to manage risk in your portfolio. Invest for the long term. The ultra-rich understand that investing is a marathon, not a sprint. They are willing to hold on to their investments for years, if not decades, to allow their money to grow and compound over time. This requires patience and discipline, but it is one of the key reasons why the wealthy are able to generate such massive wealth. Investing for the long term is a strategy favored by many wealthy investors because it can help to generate significant wealth over time. The idea is to buy high-quality investments and hold on to them for years, if not decades, allowing time and compounding to work their magic. One of the key benefits of investing for the long term is that it allows you to ride out short-term market fluctuations and volatility. This is important because markets can be unpredictable in the short term, but tend to trend upward over the long term. By staying invested over time, you can potentially benefit from the upward trend of the markets and avoid the emotional pitfalls of trying to time the market or reacting to short-term news events. Another benefit of investing for the long term is the power of compounding. When you reinvest your earnings and dividends back into your investments, you can potentially earn returns on your returns, leading to exponential growth over time. This is especially true with investments like stocks, which have historically generated significant returns over the long term. However, it's important to note that investing for the long term requires patience and discipline. You need to have a long-term investment plan and stick to it, even during times of market volatility or economic uncertainty. It's also important to regularly review your portfolio and rebalance it as needed to ensure that it remains aligned with your long-term goals and risk tolerance. Focus on quality. When investing, the 1% prioritize quality over quantity. They invest in high-quality companies with strong fundamentals, proven management teams, and a competitive advantage in their respective markets. By focusing on quality, the wealthy are able to minimize risk and increase the likelihood of generating consistent, long-term returns. Focusing on quality is a key strategy for investing like the 1%. By investing in high-quality companies with strong fundamentals, proven management teams, and a competitive advantage in their respective markets, you can potentially minimize risk and increase the likelihood of generating consistent, long-term returns. One way to identify high-quality companies is to look for those with a track record of profitability and strong financials. This includes companies with strong cash flow, low debt levels, and a history of consistent earnings growth. It's also important to look for companies with a competitive advantage in their respective markets, such as a strong brand, unique technology, or a dominant market position. Another way to focus on quality is to consider the management team behind the company. Look for companies with experienced, knowledgeable, and transparent leadership who have a clear strategy for growth and a commitment to creating shareholder value. When investing in stocks, it's also important to consider the company's valuation. High-quality companies may not always be cheap, but you want to make sure you're not overpaying for their earnings or growth potential. You can use metrics like price-to-earnings ratio or price-to-sales ratio to help you evaluate whether a company is priced appropriately. By focusing on quality when investing, you can potentially minimize your risk of losses and increase your chances of generating consistent, long-term returns. Seek out expert advice. The wealthiest investors don't go it alone. Instead, they seek out expert advice from financial advisors, wealth managers, and other professionals who can help them navigate the complex world of investing. By leveraging the expertise of others, the 1% are able to make more informed decisions and avoid costly mistakes. Seeking out expert advice is another key strategy for investing like the 1%. While it's important to do your own research and make informed decisions about your investments, the advice and guidance of a qualified professional can be invaluable in helping you navigate the complex world of investing. One option for seeking expert advice is to work with a financial advisor or wealth manager. These professionals can help you develop a comprehensive financial plan, identify your investment goals and risk tolerance, and recommend investment options that are aligned with your needs and objectives. They can also provide ongoing guidance and monitoring of your portfolio to ensure that it remains aligned with your long-term goals. Another option is to consult with experts in specific asset classes or industries. For example, if you're interested in investing in real estate or private equity, you may want to seek out the advice of a real estate agent or private equity specialist. These experts can provide you with valuable insights and help you identify investment opportunities that you may not have been aware of otherwise. Ultimately, the key is to seek out advice from qualified professionals who have a deep understanding of the markets and the investment options available to you. By leveraging their expertise, you can potentially make more informed investment decisions and avoid costly mistakes that could derail your long-term financial goals. Remember, investing involves risk and there is no guarantee of returns. It's important to do your research, seek out expert advice, and invest with a long-term perspective. That is it for today's video. Please comment down below with your insights and ideas. To learn more about business, life, and technology, subscribe to this channel, and we'll see you on our next video.